Across much of Africa, the way money works was not built for our needs. This is a fundamental, structural reality that touches every aspect of our economic lives, from the price of bread in a local market to the financing of a continental infrastructure project. Many of our prices, our savings, our borrowing, depend on currencies that are set far from here, in financial centers thousands of miles away. This external orientation creates a persistent vulnerability, making our national budget shaky, our cross-border trade unnecessarily costly, and our governments less able to act decisively when economic problems arrive. We are often passengers in a vehicle we cannot steer. This is Africa Unrestricted. If we speak from inside the continent, looking out at the global financial system, we can see the problem with stark clarity. A handful of foreign currencies dominate our international trade and finance: US dollar, euro, other foreign currencies. This is not simply a matter of which notes are used for large transactions. It is a systemic condition that embeds itself in our policy frameworks. The effects are deeply practical and felt by ordinary citizens every day. When the price of oil shifts on a global exchange or a foreign central bank adjusts its interest rates, the costs for African families and businesses can jump overnight, with little warning or recourse. The dependence on foreign currencies is more than an abstract economic concept. It is a tangible weight on our development prospects. It introduces a permanent layer of volatility into our economies generated outside our borders and largely beyond our control. Consider a small business owner in Lusaka who needs to import manufacturing equipment from Asia. The price is quoted in US dollars. Between signing the contract and making the payment, the Zambian kwacha could weaken significantly against the dollar. Suddenly, her investment cost has risen, not because the equipment is more valuable, but because currency movements driven in New York or London change the exchange rate. This risk discourages investment and makes long-term planning hazardous for entrepreneurs. Currency mismatch, revenues in local currency, costs and debts in a foreign one. When a nation borrows in US dollars to finance a new hospital or a power plant, it takes on exchange rate risk. If the local currency depreciates, the real burden of that debt increases. The government then must allocate more domestic tax revenue to service foreign loans. This can crowd out essential spending on education, healthcare, social protection. External shocks can trigger fiscal crises, hampering the state's ability to provide for citizens and invest in a more productive future. Furthermore, dependence creates a constant demand for foreign currency reserves. Our central banks must hold substantial amounts of dollars and euros as a buffer and to facilitate international payments. These reserves are our national savings lent to wealthy countries at very low rates. Holding reserves is prudent and necessary, but an excessive need for them is a misallocation of capital. We must recognize that a currency is far more than just a coin or a banknote. It is a complex system, an institutional technology. It comprises a central bank's policy framework, a network of interbank settlement rules, a national reserve management policy, and legal and regulatory frameworks that govern financial transactions. The design of this system is not neutral. It actively shapes economic outcomes. When well designed for the specific economy it serves, a currency system can be a powerful engine for stability and growth. It can support stable prices, facilitate efficient trade and investment, and promote fair access to credit. It becomes a public good that underpins shared prosperity. Conversely, a misaligned system amplifies external shocks and generates instability. If payment mechanisms are slow and expensive, commerce is stifled. If it fails to store value, savings and long-term investment are discouraged. One critical design choice is the exchange rate regime and its relationship with capital flows. The goal is flexibility to absorb shocks while preventing excessive volatility. That requires the ability to intervene, deploy macro-prudential rules, and communicate clearly. A system designed to extract raw materials for export looks different from one built for vibrant domestic markets and regional supply chains. If we prioritize financial stability and credit access for small local farmers, we will choose different rules. We must be deliberate and clear-eyed about these trade-offs. A crucial pathway toward greater monetary sovereignty lies in strengthening regional cooperation. A single country, particularly a smaller economy, may find it difficult to break away from the gravitational pull of dominant currencies on its own. By working together, nations can create a larger economic space with greater liquidity and resilience. Existing regional communities provide a foundation for deeper monetary cooperation. Coordinating monetary and exchange rate policies can lower the cost and complexity of trading with one another. Agreements to promote the use of national currencies for bilateral settlement bypass the need for a vehicle currency. Over time, regional payment systems can clear transactions directly in local currencies. PAPS is aimed at this goal. A shared currency is powerful, but success requires convergence, fiscal rules, shared supervision, and trust built over years. A deliberate, phased path is the most pragmatic approach. Pooling a portion of reserves creates a more credible buffer against external shocks than managing in isolation. A collective fund can provide short-term liquidity and help stave off crises before they escalate. Swap lines let central banks borrow each other's currencies on short notice to keep regional trade moving. This reduces the need to draw down scarce dollar reserves for regional transactions. When investors know regional support exists, they're less likely to flee at the first sign of trouble. Strong guardrails are essential. Sound policy conditions, short-term focus, and a balance of solidarity with responsibility. Access can be designed to favor local currency invoicing, nudging regional trade away from the dollar. These tools bridge today's fragmentation and tomorrow's deeper union, delivering tangible benefits along the way. One of the most practical, immediate steps is to promote invoicing of trade in local or regional currencies. This shift does not require grand treaties. It can begin with choices by exporters and importers. When parties price in one of their own currencies, they internalize exchange rate risk, instead of outsourcing it to a third currency. The risk does not disappear, but its nature changes, and the locus of management returns to the region. This creates direct incentives to develop local hedging markets. Governments and state-owned enterprises can lead by example by specifying local currency in procurement. A single policy line item can send a powerful demand signal. Financing cross-border railways or pipelines with baskets of regional currencies builds ecosystems where local money funds high-value transactions. Aligning invoicing helps correct currency mismatches on corporate balance sheets. When revenues and costs align, businesses are more resilient to global shocks. This does not remove all risk, but it narrows exposure for firms and lenders. The result can be more stable investment and employment. To work, the macro environment must be credible. Central banks must commit to price stability, and fiscal policy must be sustainable. No firm accepts a currency it expects to lose value rapidly. So promoting local invoicing must go hand in hand with sound macro policy. This is not a substitute for good policy, but a catalyst for it and for deeper local markets. Step by step, we reinforce a positive cycle of stability and growth. It is a concrete step toward building an economy that works for us. The rapid advance of digital technology creates new possibilities for redesigning our monetary systems. We may leapfrog some slow, incremental stages of reform. Several African countries are experimenting with central bank digital currencies, CBDCs. Nigeria launched the e-Naira, and Ghana has piloted a digital CDI. If designed well, these can lower transaction costs, improve payment efficiency, and enhance inclusion. Mobile money showed technology can transform everyday finance for millions. If users in Kenya can seamlessly pay someone in Uganda or Rwanda in real time, we can eliminate friction holding back small cross-border trade. This would empower the small traders, many of whom are women, who form the backbone of our regional economies. We need robust legal frameworks for data privacy, to prevent illicit finance, and to ensure cybersecurity. A CBDC should complement the banking sector, and issuance must be managed carefully to maintain monetary stability. Nigeria's currency journey shows the trade-offs of commodity dependence and the difficulty of managing FX under global stress. Early Naira adoption is modest, but the intent is clear: more efficient payments and broader inclusion. Kenya's mobile money revolution rewired domestic finance and built a ready platform for cross-border solutions. The next step is linking national mobile money systems across borders for seamless regional transfers. A system where a digital Naira exchanges for a digital CDI instantly, recorded on a secure shared ledger, could revolutionize trade. This requires intense collaboration among central banks, innovators, and regulators. Used prudently, digital technology lets us settle efficiently across borders and reduce dependence on foreign currencies for most trade. These are early signals of change, directional and practical, not celebratory headlines. In the final analysis, designing a more effective currency system for Africa is an exercise in institutional imagination and collective will. It is about choosing rules, technical platforms, and policy frameworks built for our economies and our people. This is not isolationism or a rejection of global currencies. It is about adding options that reduce friction, protect households from external shocks, and enable deeper regional trade. We need coordinated actions, strengthen central bank independence, credibility, and transparency, build digital and regulatory bridges for cheap cross-border payments, and develop more liquid local capital markets. Pilot carefully, then scale digital innovations. Reforms must be pragmatic, sequenced, and evidence-based, with safeguards against foreseeable risks. Start with practical steps. Enable local currency settlement among regional partners, build shared liquidity facilities and supervisory systems, and learn from pilots before scaling. Our prosperity rests on many pillars, and the design of our money is one of the most critical and overlooked. Signals of change are here. The task is to connect the dots and accelerate progress. We can design a monetary architecture that helps us trade with each other, save for the future, and build a more resilient, self-determined continent. The global system is a reality we will navigate with clarity and purpose. By taking conscious control of monetary design, we reinforce our agency and our capacity to build for the next generation. Calmly, confidently, and together, we can align our currency systems with our development goals. That is the structural task our generation is called to undertake.